Imagine you just sold your investments and made a handsome profit of 2 crores. But then comes the taxman ready to snatch 25 lakh from your gains. But what if I told you there's a way to save every single rupee of the tax legally? Today we are going to uncover how to save 100% of your capital gains tax, the key conditions you must need to follow, and finally whether this strategy is right for your financial goals or not. So the feast is ready, it's time to serve. In last video, we discussed two main factors you must consider while planning your financial goals. If you missed it, I recommend watching it for better context. Now let's tackle today's issue, taxes on capital gains. As we saw in the last video, long-term capital gains tax is 12.5% after an exemption of 1.25 lakh. That means if your total gains are 2 crore, you'll lose 25 lakh to taxes. That's like 12.5% of your profits gone in an instant. But here's the good news. There's a solution in the Income Tax Act called Section 54F, which lets you save the entire 25 lakh legally. So, what does Section 54F say? Under this section, if you sell a long-term capital asset like stocks, mutual funds or properties and use the sale proceeds to buy or build a residential house, you can claim a full exemption from capital gains tax. Let's break it down with a simple example. You sold your investments and made 2 crore in gains, and for that 25 lakh is the tax you need to pay. Instead of paying 25 lakh in tax, if you invest the entire 2 crore in a residential house within 2 years or construct a new one within 3 years, you pay zero tax on your capital gains. But there's a catch. To qualify for this exemption, there are certain rules you must follow. First, you should not own more than one residential house on the date of selling your asset. Second, you must purchase the new house within 2 years or construct it within 3 years from the sale. And if you sell that new house within 3 years, the exemption gets reversed and you'll have to pay the tax you saved. And lastly, the exemption applies only if the entire sale proceeds are reinvested. In our case, it is 2 crore. If you reinvest only part of the proceed, the exemption will be proportionate. For instance, if you invest only 1 crore out of 2 crore, you will save tax on only half of your gains, which means you will save only 12.5 lakh out of 25 lakh. Now comes the big question, should you use Section 54F? This strategy is great for people whose financial goal is to buy or build a house, as owning a home is a dream for many. And this strategy will not suit for people whose financial goal is to create wealth through investments, because locking your gains into real estate may not be ideal, and it's not as liquid as other asset classes like mutual funds or stocks. So accessing your money can be tough in emergencies. That's why it's important to align your tax saving methods with your long-term goals. Finally, to wrap it up, Section 54F lets you save 100% of your capital gains tax by reinvesting in a residential house. But this method works best if your financial goal aligns with buying or building a house. And most importantly, follow the conditions carefully to avoid losing the exemption. And that's all for this video. But wait, so far in all our calculations, we assumed 15% returns, but we never discussed how to achieve that. And that's the lead for my next video. Stay tuned. Until then, this is Sabarish signing off.